Just over 2 months ago, we said our pensions were heading towards 80% cash. Well, now we have an update. My pension transfer from my old workplace pension to my self-invested personal pension finally went through. And for the last 8 weeks, it's been sitting as cash. Or to be more correct, in overnight money market funds. So let's take a look at the exact breakdown of all of our pensions combined. So that's our 2 workplace pensions and our 2 SIPs, and covers the total pension position for both my wife and myself. We have 6% as cash, which is currently yielding just over 2%, and 76% in overnight money market funds, which I consider as cash and is currently yielding about 4.2%. So that's a combined figure of 82% invested in cash and cash equivalents at an average yield of about 4.05%. The remaining 18% is invested in equities and bonds, with the far greater majority being in equities. So, are we crazy to have such a large figure of 82% invested in cash? Whilst cash is safer than equities, you do potentially miss out on the growth associated with equities. So where has the stock market been going over the last 8 weeks? Nowhere. It's been broadly flat, whilst we've been earning a small amount of interest. The UK, US and indeed worldwide stock markets have gone nowhere. So I realise I've been very fortunate with my timing. In fact, the first half of this year I had a decent amount invested in my workplace pension, and this experienced the growth of the first half of 2026. My workplace switched to an alternative provider, and I was able to transfer the old scheme into my SIP. The transfer went through almost to perfection, just as the markets peaked. And since then, as I've said, it's been sitting in overnight money market funds. Now that doesn't mean I've made the right decision. In fact, I want to put far more of our portfolios into equities. However, at the moment, I just don't feel they offer good value. And to be fair, do I actually need the extra risk of equities in our portfolios? The overnight money market funds, well, they more than cover the inflation rate, and we're currently on track to retire at 57 as long as we match inflation. So let's look at what could cause inflation. The main risk I see is the rising tensions in the Middle East. The conflict seems to be growing in size with additional threats to the Red Sea alongside the existing problems in the Strait of Hormuz. This could cause increased inflation risks globally and be bad for the stock market. But then on the other hand, by settling for such a large position sitting in cash, we could be locking into a poor retirement by not having any significant growth and fully depleting our pension pots by the age of 67, which is still 14 years away and plenty of time for investing in equities. So, with 14 years of growth until we are due the state pension, you would expect reasonable growth from the equity markets over that time frame, and it should be above what you would get from overnight money market funds or bonds, and leave us with an excess amount in our SIPs at the age of 67, which could provide a very nice bonus on top of the state pension. So by leaving it in money market funds, we could end up being cash rich and flexible with our drawdown timings, but also poor in retirement. However, the risk with equities is that we get into a stagnant period, like what happened between the year 2000 and 2012, or even worse, a fall. Equities are not a guaranteed one-way path to growth. And at current valuations, with AI companies pretty much valued for perfection, I see the risk of losses far greater than the prospect of growth. So what's the worst that could happen? Well, we could end up with a flat or falling market over the next 4 years. That's easily possible if the conflict continues and higher oil prices lead to a general worldwide recession. Then in 4 years' time, we're at 57 and wanting to retire. Starting our pension drawdown during a market downturn, that could lead to what's called a sequence of returns risk, by being forced to sell equities at a price below what we bought them at, decreasing our pension pots and forcing more than planned equity sales the next time we draw down. So we always have to make sure we have a decent percentage still invested in money market funds. So not the 82% that we currently have, but we certainly need somewhere between the 20 and 40% figure, I would guess. At this level, I would feel comfortable and I wouldn't have sleepless nights if the stock market took a downturn. So, whilst I want to invest more in growth stocks, and I see the US as remaining keystone in worldwide growth, I have to be careful not to risk our solid retirement position. As far as investments go, there are a couple of funds that I'm interested in. One is a US tracker for the S&P market and has very low fees, and the other is a global tracker. So the S&P 500 tracker ticker symbol is VUAG. It's an accumulating fund by Vanguard and has ongoing fees of just 0.07% per year, and over the last 5 years has grown by 87%. The global fund that I'm interested in is another accumulating fund, also by Vanguard. It's the FTSE All World ETF, ticker symbol VWRP. It has ongoing fees of 0.14%, having just been reduced from 0.19%. And over the last 5 years has grown by 72%. So I could drip feed it in slowly over time, but my preferred option is to wait and keep the funds as they currently are and drip feed it in chunks when the market experiences a pullback. I've also looked into value shares, but I'm not as interested in these, as what's valued today could be expensive tomorrow. I would rather have a mix of very safe investments like overnight money market funds and then some riskier ones, but on the index level rather than specific shares. So I know the old saying, and I'll probably get a lot of comments that say this, time in the markets is better than timing the markets. But I don't know. Maybe it's my frugal side, but I just find it really tough paying over the odds for things. And that includes investments. And what if we stay invested in money market funds at this large percentage? What's the worst that can happen? Overnight money market funds should beat inflation, or certainly match it over several years. So sure, we would be missing out on growth, which isn't ideal, but then our plan works at the moment. We're 90% of the way there, and we're fine with the projected totals as they currently are. So if you think we're going to lose sleep over some missed growth, then that's not going to happen. What would you do in our situation? Would you put the cash straight into stock markets at the current levels? Would you feed it in gradually? Would you buy the dips and only invest on days that the stock market is declining? And what sort of funds would you invest in? The UK, US, or worldwide? Or maybe you'd invest in something different like government or corporate bonds. Let me know in the comments, as I feel this summer our pension pots are at an inflection point and one decision, good or bad, could make or break our plans. Thanks for watching, and I'll see you in the next one.